Let us try to understand revenue. Unbilled revenue is also known as accrued revenue or contract asset. Unbilled revenue is the revenue earned by providing goods or services to client in the current period, but the invoices for these have not been issued to the client. Unbilled revenue, or in other words, unbilled receivables, is shown as an asset on the balance sheet. Once the invoice is rolled out, the balances in unbilled revenue or unbilled receivables moves to accounts receivable. Billed receivables is the normal scenario where the revenue and billing happens in parallel. And deferred revenue is when invoicing exceeds the revenue. It is unearned revenue as we have billed the client in advance and the client may have paid the invoice as well. However, the service or goods delivery is still pending and hence the revenue is deemed to be unearned. To summarize our understanding, let's look at this table. Under unbilled revenue, we can consider revenue as goods or services are already delivered, but no AR can be considered as invoices is not at risk. Under billed revenue, we can consider revenue and AR as goods and services are already delivered and invoices have also been rolled out. Under deferred revenue, we cannot consider revenue as goods or services are not yet delivered, but AR can be considered as advance invoices have been raised. So just to reiterate, summarize, unbilled revenue, it is only the revenue which can be taken. Billed revenue, revenue and AR can be considered. Deferred revenue, only the AR is considered. So let's take an example to understand unbilled revenue. So when there's an unbilled revenue, the accounting entry would be unbilled revenue to revenue. And when it is billed, it is accounts receivable to unbilled revenue. In billed revenue, the direct entry would be AR to revenue. Under deferred revenue, the set of entries would be accounts receivable to deferred revenue. And once we consume or deliver, once we deliver services, the entries would be deferred revenue debit to revenue. And the same entries would flow month on month. So these are the three examples and I'm sure you would have understood unbilled revenue, billed revenue, and deferred revenue concepts. Dunning letters is a formal communication to customers requesting them to remit the overdue invoices at the earliest, since these are past dues. We gradually build up the tone of the reminders for aged receivables. The intent is to make the client respond, contact us as soon as possible to address the concern. In letter 1, we will try and impress upon the client with a reminder that overdue payments needs action from their end. In letter 2, we'll again emphasize the payments are getting significantly delayed and the account would be placed on credit hold for lack of a response. In letter 3, we will gradually increase the tone of the mail and we'll say that a formal collection process or would be initiated or we'll involve a third party for collection. In letter 4, it will be a stronger email where we indicate to the client that we are forced to proceed with legal action to collect the overdues. So these are a very high level format or a mailer sample which can be used for a dunning letter. So DSO swing. Uh, In this section, we will try and understand the lesser known factors which impacts the DSO or swings the DSO up or down. Most of these factors are uncontrollable, and the operational team would have lesser control or influence on the impact. So let us look at these factors one by one. Revenue in a particular quarter is not evenly spread out throughout all the 3 months, and it is skewed to one of the months. It would impact the DSO adversely if the revenue in the third month is higher than the first 2 months. If an acquisition happens in the third month of the quarter, the receivables is considered as it is, but the revenue included is only for the third month. You would need full 3 months revenue to show the right DSO for the acquisition. Also, the acquired entity may have different policies on collections and dunning process, and hence may have a higher DSO. As an organization, the revenue will grow, no doubt. However, if the revenue growth is in accounts with higher payment terms, then it is detrimental to collections and DSO. It is important to revisit the payment terms when the account is fast growing. Aged AR having a 100% provision for doubtful debts when collected does not have any impact on the DSO as it nullifies both the AR and the provisions. Unmapped credits, whether it is cash receipt or credit notes, has an impact on PDD. The invoice for which the credit is raised is open in our systems and hence will qualify for PDD or provisions, which would not have been the case had it been mapped and closed before reporting. So these are some of the factors which actually swings the DSO. These factors are other than the normal factors which we discussed earlier.